Good afternoon. Thanks for joining us. We're going to go ahead and get started in just a few moments.
Hi, welcome everybody. Good afternoon. This is Alex Barnes, with Cornerstone Wealth Group. If y'all been on a webinar before with us, you may have seen myself. Today we have a few special guests joining us, and I think what is probably the most common question of really the past few weeks and for the next 30 days as we head into the election season. So again, thank you for joining us this afternoon. So quick introduction, two people that are on this call with us. We have John Capecci, who is a regional director with Fidelity Investments, has been a longtime partner of Cornerstone Wealth. And John actually has set up a call today with Brad Fennell. Brad Fennell, he is part of the Capital Market Strategies Group. He is a lead strategist with Fidelity. And Brad, we really appreciate you taking some time out today. I had the pleasure of being on this call that you did a couple weeks back, and really think that our clients will really learn a lot from you and what you have to say both about the markets, COVID-19, which is obviously still the talk of the town as we are now into our sixth, almost seventh month of dealing with this pandemic, and then now we get to talk about the election. So I'll go ahead and hand it over to you, and please let me know if you have any questions, if you need anything from me as we go through this.
Okay, you bet, Alex. Well, thanks for the warm introduction. Thank you, Ashley, and John. Good to be with you, of course. And good afternoon, ladies and gentlemen. I hope you're doing well. I believe most of you obviously are in the greater Charlotte area or Western North Carolina, and I hope everyone's having a good day and a good fall so far. I'm here in Massachusetts, 70 degrees, plenty of sunshine. So as far as mid-October here in New England, things are just fine. And Alex, you obviously bring up this topic of election 2020. Without a doubt, it is a variable that is an uncertain one, right? And in the scope of today's discussion is really to share our Fidelity's perspectives as to how we see the election playing out and whether or not this is something we should be overly concerned with, and really provide some historical context on the very fact that this catalyst, at least historically, has been a fairly benign and neutral one as it relates to our investments, right? And ultimately, that's the end goal here, at least for this discussion, as how the election may impact the portfolios that you all have. In addition, when we think about the words catalysts or variables or factors, you really have to incorporate more than just one when you think about any outcome. I would say that's probably a general rule for life. But as far as portfolios are concerned, when we think about the election, we talk about how I've just mentioned it probably will most likely be a neutral catalyst, but there are other catalysts that we would want to consider that perhaps have some more durability and they could be positive. And Alex, you mentioned one right up front, COVID-19. Hard to believe, but 7 months in, kind of crazy, right? How time has gone by so quickly. But in that 7-month period, there's still a high level of anxiety, fear, and again, uncertainty as to how this particular virus plays out. We don't know with any certainty or 100% certainty as to how this virus will play out. All we can say is that the headwinds that this topic, the global pandemic, has presented could certainly become less negative and perhaps more positive here in the near future. And of course, I'm just positioning that a cure or some type of vaccine or even more therapeutic medicine could be something of a substantial positive for this virus. And I think a lot of you will agree. And perhaps just summarizing the virus, and we could talk a lot more about it if you like, but just thinking about it, it's only a matter of time until we have a cure. And while that's not going to eradicate COVID-19, it should certainly allow for confidence to increase precipitously for both corporations and for individuals like all of us. So that's something that could be a positive for the portfolios over the next, call it 6 to 9 months. And the other catalyst here, if we think about it, just going to share with you two that we need to think about is Fed policy. And really, spoken more generically, central bank policies, not just here in the United States, but globally as well. All the major central banks of all the major economies, right? Bank of Japan, Bank of England, European Central Bank, so on and so forth. They are all easy right now. They are all loose with their monetary policies, and they continue to induce liquidity across the globe. And that is a very powerful observation. And one could argue it's the primary reason why the markets are up nearly 70% from the low that we saw on March 23rd. Lots we could say, but to pinpoint it in an easy way, the Fed and the other central banks have allowed risk assets, stocks, to do very well here the last 7 months. And the kicker is they're going to continue to remain easy. And we'll talk a little bit more about that here in a few moments. But that is something that, again, we should not overthink. It sounds bullish to us. Now, we're not overly enthusiastic about the next 6 months in terms of risk because there are certainly things that could go wrong, and we'll talk about that here obviously as well. So let's get into it. The first part of my prepared remarks around the election will be the historical observation, right? So thinking about elections and how they've played out. Then we'll look at some policies that's on everybody's mind. And then lastly, we'll speak briefly about the portfolios and maybe be a bit prescriptive as to what we think should happen there. So let's take a look at history. Now, what you can see here is we're sharing 81 years of data, and this is going back looking at elections, and there's so many different elections here, of course, going back to 1936, FDR's second term. And if you look at the data, all we're suggesting is the main takeaways here is that the market tends to get a bit more subdued as you go into the election. It remains subdued as you come out of the election. And then, quite frankly, the markets are upward leaning, right? The markets are positive on average going back over this 81-year period. That's number one observation. The second observation is you'll notice this polka dotted set of bars represents the data around the incumbent party winning. So this is either a re-election or it's just the prior party winning once again. So think of George H.W. Bush winning after Ronald Reagan. So we had a continuance of Republican leadership, but then we also, so that's the incumbent party winning. The incumbent party losing, same story with George H.W. Bush when he lost in 92 to Clinton. Obviously, we went from Republican to Democrat. And there's lots of examples going back in time where the incumbent party has lost and we saw a change in party leadership. The difference there is when the incumbent party wins, you'll see how the performance is a bit better. But keep in mind, look at the scale on the y-axis here, right? We're not talking 10 to 30%. You know, it's 1, 2, 3. So yes, definitely higher, both on the front end and the back end when the incumbent party is looking pretty good to win. And then, of course, when they ultimately do. When the incumbent party loses, the market tends to sniff that out, that there could be some challenges for the sitting president or the incumbent party. And you can see how the market's typically down around 2% in the 3 months prior when the incumbent party ultimately loses. But again, even if that were to happen this time around, again, based on history, the incumbent party losing doesn't mean that at the year and the next 2 months, 6 months later, or even 12 months later, that we're going to see negative returns. Anything's possible, but the historical data would tell you otherwise. Another way to kind of slice this data is looking at the presidential cycle. A lot of us know there's 4 years, right, to a presidential cycle, and it's the 4th year that has the election. And what you can see in this red bar is the performance is fine, right? Really nothing to see here. In fact, the returns in the 4th year of a presidential cycle are nothing unlike that of years 1 and 2. And so even though a lot of people feel like, typically elections kind of move the markets, they really haven't been shown to do that. And another way of looking at this historically, again, over the same period of time, is that when you average years 1, 2, and 3 of the presidential cycle, right? So these are the non-presidential election years, and you compare and contrast to that of the presidential election year. They're both upward leaning, even if the election year kind of has a tale of two halves, right? The first half is a bit muted in terms of returns on average, and then you can see the second half, you get a nice pop here. This is that 6.3% on average. The other observation that we've made is both time series of data tend to have inherent seasonality in this third quarter. All we're suggesting there is that the markets get a bit, let's just say, benign and move a bit sideways in the August, September, even into October timeframe, not just the presidential election year, but really on average. And then just like that's a bit sideways, the fourth quarter, really November, December, tend to blossom in both non-election and election years, right? The market's typically upward leaning. And I don't know how closely you follow your investments, but in a good year, you tend to see a lot of momentum rush into the last couple months of the quarter, and especially if it's a good year, you just feel better, right? Because your money's working for you. And we believe, especially in an election year, just knowing the outcome of the election, right? Even if it's not your candidate, you might be a bit sour about that, but knowing that there's less uncertainty, the markets most likely pop in a significant manner. And you can see that line right here. That's what that represents on average. A declared winner is in itself a positive catalyst for the market. Now, I did sniff this out a bit earlier. I foreshadowed the fact that when incumbent parties go on to lose their election, the markets are already down before the election, right? That's a big distinction. The market's not necessarily down post-election when the incumbent loses. It's down before. And what we've done is we've overlaid both the incumbent party losing and the incumbent party winning. So we've already kind of looked at this data a little bit, but it's just showing you it via the calendar year. And then we've overlaid the 2020 returns, right? So you know that this was a pretty dark period, but we can forget about that. Not that we can just forget about it, but certainly it's old news because the market's up, as I mentioned, almost 70%. This green line, if you want to get right up to date, is right around here, just below the highs we got in early September, but the market is up about 9% year to date, about 8.5% as of last night. So the question now becomes why, right? What's the phenomena about the markets? Why are they down when the incumbent party tends to lose? And it may have something to do with weaker equity performance reflecting a softer economy. Now, we don't have that yet this year. We still have 3 weeks to go until the election. As we know, anything's possible. But so far, the market's up pretty handedly. And there's lots of reasons for that, one of which, again, is the unprecedented amount of central bank policy. But if you were to look at history, this is going back to 1900, there's only been 5 United States presidents who have been one-term presidents. And all 5 of those presidents, right, who did not go on to win a second term, all of them had a recession in the 2 years before their respective reelection. All right, so they have something in common on both fronts, right? One-term presidents and also had recessions. You can see all these presidents here who have won did not have recessions. So these are facts, right? It's not a rule, although it does seem to be one because the only exception to that rule is President Coolidge, who of course was the vice president under Warren Harding in the early 1920s. And 2 years into President Harding's term, he did drop dead, sadly, of a heart attack. So the vice president becomes the president. And of course, President Coolidge was a pretty popular guy. The 1920s were a pretty fantastic period. And one could argue that the recession was more of a Harding recession and less of a Coolidge one. But factually, he did buck this trend, although I guess back then it wasn't much of a trend, right? It was just William Taft. So as we think about it, when we put this all together, the idea is recessions kill U.S. presidencies. The fact is we've had a recession here in 2020. Could Donald Trump be the second outlier in addition to Coolidge? Well, I mean, just one simple facet here. The recession was hardly incubated by the Trump administration. I don't feel like that's a partisan opinion. This was more of an exogenous demand shock called COVID-19. And even more than that, because we've seen viruses come and go before, this one was a bit different in a major way because of the Great Lockdown. So the government's response, especially in the Western world, was something that was even more out of left field than the virus itself. As I've mentioned, we've had pandemics even in recent history, but this one again kind of took on a different took on a different route. So with that being said, the economy was strong coming into 2020. We know that the unemployment rate touched almost 15%. It's now less than 8%. And we also know that because of the CARES Act that we saw pass back on March 27th, the CARES Act wasn't just an income bridge, right? It was the biggest income Band-Aid we've ever seen in the history of our economy, to the point where those people who are unemployed, frankly, on average, are making more money by not working, or at least they were, right? We know some of those benefits have expired. So the question does become, right, will President Trump succumb to this history of recessions killing presidential re-elections? Again, we'll find out here in a few weeks. Now, the polling data has already made up their mind, right? The national polls, perhaps a bit rhetorically, have Joe Biden leading. This is actually stale data. I know it's less than a week old, but it is stale already. This number is now 13 percentage points that Joe Biden is leading in the national polls. Now, a few thoughts here. Right, these are the national polls, and the national polls have proven to be inaccurate before. So if you are a Trump supporter, you're certainly going to make that argument, and you might be proven accurate or correct. The other component I feel like is even more newsworthy is the swing states, right? It's one thing to say the national polls, such as a California, a Massachusetts, a New Jersey, right? These predominantly large population centers of the country, you would imagine, right, very logically, that Joe Biden would be their candidate. But when you start to look at more of these swing states, which frankly are becoming a lot more purple, your own included, these show you a little bit of a different story, right, where Joe Biden is still leading, but one could argue by a margin of error in some of these significant states like Florida, North Carolina, certainly Georgia, Ohio, and Texas. Who would have thought that would be a swing state? But as you probably know, Texas was predominantly a Democratic blue state prior to the Kennedy election in 1960. And California, believe it or not, was more Republican. But nonetheless, these things do change, I guess, over a generation. We still feel like perhaps the race is a bit closer than what the national polls would indicate. And the other component here is if you just take a look at the percentage lead for Biden versus his other Democratic candidate 4 years ago, Ms. Clinton, what you'll see is the big takeaway is Joe Biden is at least perceived to be a more favorable candidate than Ms. Clinton was 4 years ago. And one could argue this actually bodes well for the Democrats and perhaps diminishes some of the observation that Trump didn't do necessarily well in the polls, but he ended up winning the electoral vote. What I mean by that is Ms. Clinton had some significant amplitude in terms of she was leading here significantly, and then she wasn't significantly, and ultimately a week prior to that election on November 7th, November 8th, she ultimately lost. You can see how former Vice President Biden is polling a bit better here, and it's, I would say, a bit smoother. Don't read into it too much. It's just the observation that the political analysts I work with have continued to tell me that this time around, Biden seems to have higher favorability ratings, or stated more bluntly, Hillary wasn't a much better choice than Donald Trump. And no offense, hopefully, if anyone was a big fan of Miss Hillary Clinton, but Joe Biden does seem to be polling much better than Clinton was 4 years ago. So that could spell some trouble for obviously the incumbent this time around. Switching gears to the congressional balance of power, kind of stating the obvious here, but I feel like these are fascinating lines only due to the fact that the percentage odds, now this is not so much polling as it is predicted, and predicted is an area that basically presents odds on a long list of different observations in society. So if you want, feel free, you can bet on who's going to win the United States Senate, and perhaps you do it in your portfolios. But so let me state the facts here. 63% odds that the Democrats will take the Senate and as well keep the House, right? The House doesn't seem to be much up for grabs, but the Senate certainly is. But keep in mind, look at how this line has evolved, right? Really in just the past 12 months. The U.S. Senate was firmly in the hands of the Republicans. Very, very little chance, 20% chance here as early as pre-pandemic that the Republicans were going to lose. And then you see these really three spikes, and I'll just observe each three or each one of these. First one, pandemic. So the pandemic takes those odds from 20 almost to 50%. And one could argue it wasn't just the pandemic, it was also the economic lockdown. It didn't do any favors for the incumbent leadership, right, in the Senate. So 20 to 50. And then we saw this kind of ebb and flow, but then we saw the social unrest and the racial inequities and systemic racism and that whole narrative, which is still with us, of course, but it was very poignant and very acute in the summer, especially June. Again, did not help the incumbent leadership. We saw things get a bit better here into September as perhaps there was a bit more of a normalized environment, kids going back to school, colleges reopening, sports, especially football, right? So life kind of seemed a bit normal, at least for a weekend or two. And then, of course, we saw this spike up here. Two things: the debate performance has been cited as a negative for the president, although I don't feel like that was, I'm not going to say it was a negative or not, but I don't feel like that was the main reason. Of course, just several days after that, the president did come out with a positive COVID test. That was really what shot these numbers up. It just illuminates the fact, even though he's recovered, it illuminates the fact that what initially brought this probability up is still highly relevant, right? When the own president of the free world has contracted it. And of course, it seems like a large number of the White House staff has contracted it. Right or wrong, the optics just don't look great is the idea. And that's what's brought this number up. Now you might be wondering, does that mean the Senate goes blue? Well, the numbers would tell you, sure, the odds are that the Senate will go Democrat. However, less than 3 weeks to go in this type of election is a lifetime. I almost feel like it's the New England Patriots being down to the Atlanta Falcons 28-3. Now, I don't want to equate the Patriots to Donald Trump or Republicans, but the idea is who would have thought they'd win that? And I feel like anything's possible. So there's certainly still hope for the Republicans to maintain their leadership in the Senate. And it's really going to come down to these 12 races, right? These are the key races in the Senate this year. And the way to read this as you digest it is this is looking at these 12 states, and it's representing what the lead is for the Republican candidate or the Republican candidate lead, right? And if you see a blue bar, the incumbent is Democrat. So Doug Jones in Alabama, you see that first bar here. It's an 8-point lead for Republicans. It's actually more like 12 points over the weekend. So Doug Jones doesn't seem to be polling well, and there's a very good chance that that will flip over to Republican. As you probably know, and I know my friend John Capecci knows, it's the former head football coach for Auburn who's running as the Republican, and he seems to have some pretty good traction there in Alabama. South Carolina, Lindsey Graham is polling poorly, actually, even though it's a 6-point lead. This is now more like 4 points. It was as high as 15 in July. So just to show you some of the collateral damage in terms of the perception that Republicans won't do so well. Again, just a perception. Mr. Graham is very well liked, and he's a stalwart in South Carolina politics. It would be a major surprise if he doesn't win here. If you look at Georgia, obviously just to your south, David Perdue, the incumbent Republican senator, facing off against the young Democrat John Ossoff. You can see obviously that Mr. Perdue does have a comfortable lead, and this is just one of two races in the Senate for Georgia. There is that special election, and by last count, 22 candidates running for that special election. Can you imagine? So the challenge with Georgia is, unless a candidate gets 50% of the vote, what will happen is the top two candidates will go to a special runoff, and that won't happen until January 5th. There's a chance that Perdue and Ossoff, both of them, neither one may get 50%, so we'll have to redo this again Jan 5. And in the special election, with Ms. Loeffler being the senator who was appointed by Governor Kemp, the idea is there's 22 candidates, so there's a good chance no one's going to get 50%, especially with the two top people, Collins and Loeffler, kind of fighting it out. So again, as we think about this, you could really see the Senate in flux here, because that could be two seats that we just don't know until post New Year. North Carolina, obviously relevant. Thomas Tillis, the junior incumbent Republican senator, not polling so great against Cal Cunningham, the Democratic challenger. We shall see. I think there's some hair on both sides of that story, especially with the Democratic challenger. But so far, the polls are swinging in the form of the Democrats. And then Arizona, I'll just tell you that Martha McSally, who filled the late John McCain seat, she has her work cut out for her. She is facing off against I believe it's Mark Kelly, the former astronaut, who's married to Jeffords, who shot. So there's a story to be told on the Democratic side. And then Maine is a state up here in New England, a 25-year senator, Susan Collins, who's been really popular in Maine. She's just not polling so well for different reasons. That state continues to get a bit more purple. And then Colorado, it does appear that it's over. Although I will tell you, there was a debate last night in Colorado between John Hickenlooper, the former Democratic governor. He did run for president, so you might have seen him in some of those primaries. Speaking up there, it's kind of a unique name. Cory Gardner's the junior incumbent Republican senator, has some work to do here. A few facts for you. This is just 12 races. There are 35 Senate races this year. Of the 35, 23 are Republican incumbent, 12 are Democrat. As you probably know, the Senate enjoys a 53-47 majority for the Republicans. So the Democrats only need 4 seats, a net gain of 4 seats for a majority. And frankly, they only need 3 seats if they win the White House, as the vice president would be the tiebreaker. So Ms. Harris would provide that tie-breaking capability. So again, doesn't mean the Republicans can't win this, but it's obviously going to be an uphill battle. So let's transition to policies.
Brad?
Yes.
Hey, I just want to take 1 second here, or 1 moment. For anybody that's on the call, because I did notice we had somebody raise their hand a moment ago. We're going to keep all of our attendees on mute, so that way we don't, obviously run into somebody trying to talk over anybody else on accident. But if anybody does have any questions, please make sure to submit them. There's a Q&A button at the bottom. You can type them in. I'll make sure that we get to those hopefully between now and the end of the call with Brad. I just wanted to take a moment and make sure everybody knew that.
Thanks for saying that, Alex, and I should have said that maybe up front. So let's transition to policies, and this is, I would tell you, where the hot topics are coming into play. So let me be as transparent as possible. The policies that we have here on the left-hand side, these are the general policies that any administration would employ, going back to Grover Cleveland, right? Quite frankly, post Civil War. And the reason why we bring these 4 up is because these are just generic policies, nothing partisan about them. But what we wanted to do is look at these 4 through the lens of the different election outcomes. So the first one is one that you need to respect, right? It's not over until it's over, and that's the status quo, where Trump ends up winning, kind of shocks the world even more than he did in 2016, arguably. The Republicans keep the Senate, and the Democrats in all 3 of these under Speaker Pelosi There doesn't seem to be a play for the Republicans to take over the House, at least not until the midterms in 2022. So that's the status quo. Second scenario, Joe Biden wins, right, as the polls have indicated. The Republicans keep the Senate, and therefore we have a split Congress with a Democrat White House. And then lastly, we have unified government, and of course it would be the Democratic sweep where Biden wins and the Democrats under Schumer become majority lead. So the way to read this, and this is our hypothetical, just our educated hypothetical, lots goes into it. We didn't just throw these plus and minuses on the screen and move away. We spent a lot of time on it. And if you think about taxes and regulation, one could easily conclude that under the status quo, these are not going up, right? I think you can appreciate that. So therefore, the stock market, right, the plus and minuses represent the direction of prices in the stock market, and we feel like that could be a positive for the market. When you move over to Biden with the split Congress, we believe that because the Republicans would keep the Senate, that would basically be an effective firewall against any tax increase, and that would certainly dampen any type of policies that the Biden administration would want to get off, especially around tax increases. So therefore, taxes won't go up under McConnell's leadership. That could be a positive for the market. Regulation, on the other hand, there's a whole swath of regulation that happened without legislation, right? And that can happen via executive action, meaning the president autonomously can enact more regulation or deploy less regulation, and they can do it without any legislative approval. In fact, Donald Trump did a lot of it against what Obama had done in his term, and certainly if Joe Biden wishes, he can do the same. So that could be perhaps a headwind for the market. And then, of course, unified government democratically, you could see taxes going up and regulation going up, which is a perceived threat to the stock market. Now, if we stopped there, that would be imprudent, very short-sighted, and we'd be wrong in our conclusion. So we have to incorporate fiscal stimulus, right, first and foremost. And the idea here is that we're not so certain that the Republican stereotype of fiscal austerity or fiscal conservativeness, we're not so certain that we would get more big-time stimulus if we had status quo, right? Trump wins. Does he really need it? We don't know, right? We could see infrastructure, but again, it's a question mark. We actually feel less positive about it if you had bipartisan, or I should say partisan politics here between Biden and Mitch McConnell. So we would call that a negative here. That would be the lowest likelihood for additional fiscal stimulus. And then lastly, the highest probability for more stimulus would certainly be under unified government. And for what it's worth, the proposal under Joe Biden has been a $4 trillion stimulus package post 2021, so sometime January, February, March. We shall see. We've heard this type of line before, but nonetheless, that's what we have to work with. Trade policy, very quickly. It was a perceived negative under Donald Trump. It will continue to be so, just given the rhetoric around trade and the potential for trade wars, not my words, but the media's. And Joe Biden perhaps could take or employ a much more softer tone, incorporate much more of a multilateral approach, meaning engaging other major economies, G10 economies, to help with the global trade initiatives, especially in China and Europe. So those could be perceived positives. And also there's a strong rumor going around, just a rumor, that tariffs would be removed on Chinese goods, which could obviously be a positive for the market, allowing more consumption. Let me take an in-depth analysis here, but keep it very high level on the subject of taxes, because this comes up all the time. The bottom line is this: tax increases historically have actually been good for the stock market. Now, how is that possible, and what do I mean? The average stock market's return is 9% going back to 1950. But yet, in the years in which personal, corporate, and cap gains have gone up, right, either individually or in some cases altogether, the market has done very well on average, right? We've seen personal taxes go up 8 times since 1950, corporate 5 times, and cap gains 10 times since 1950. And you can see these numbers in parentheses indicates what percentage of each one of those was actually resulting in a more positive average return than the average. So corporate taxes have gone up 5 times. all 5 of those, the returns in the stock market in that year they went up was better than the average of 9%. And you can see the average has been 13. Now, the most prevalent reason why this is a truism, right, at least historically, is every time we've seen taxes, we've typically seen some type, right, of government spending. And the facts are that government spending, when you think about fiscal dollars, right, because fiscally there's only 2 things you can do, right, via fiscal policy. One is spend more government money, even if you don't have it, which, let's face it, we don't. We could talk about that if you like. And 2, cut taxes, right? That's how you stimulate an economy. Government spending has mostly been a Democratic initiative, right? At least in modern day, and tax cuts have mostly been a Republican initiative. Now, those are stereotypes if there ever have been, but that's basically how people are thinking about it. And government spending has had a much higher bang for your buck than tax decreases will ever have. And that's, you know, something that we feel very, very genuine about, and we have to say it with emphasis because you can see how the markets have done well. And let's face it, the only way, or the primary way, we get tax increases is with unified government, but that just also happens to be the scenario in which we most likely get a lot more fiscal stimulus. So, you know, we shall see what happens going forward, but at least historically, tax increases have been accompanied by an increase in government spending, and that has certainly offset the deleterious or negative effects or perceived effects of those tax increases. And then what we feel really matters, and I did foreshadow this before, the recession is over, right? And this is the way that we keep things in check here at Fidelity. We think of the economy in 4 distinct phases: early, mid, late recession. And the idea is in a recession, obviously, and we'll talk about this, but a recession doesn't do anyone any favors. Most of the world's economy was in a recession for really the entire spring. Now, the facts are that most of the world's economy was not in a recession up until this pandemic. In fact, most of the world's economy was enjoying a very long and what was about to become an even much more longer economic expansion. And we know that's true because the monetary policies of the last year certainly became much easier. Let us not forget, it was the Fed Reserve that cut interest rates 3 times in the summer of 19. I know it seems like an eternity ago. It certainly does, right? We can smile. But because they cut, we didn't feel like a recession was an inevitability, right? In fact, we just thought it was a remote possibility. And we continue to say late last year into early this year, the main way we get into a recession and a contraction is if we have an exogenous shock, right? Something that nobody really banked on. And sure enough, the coronavirus kind of filled that void for us. So we were in a recession. You can see some parts of the global economy is still there, although these are slowly coming out of it. And I suspect any day now, Japan especially will come out. Brazil and India and Mexico have all come out of their recessionary period. So we're now here in an early cycle recovery. That bodes very well when almost 80% of the global GDP growth is now early cycle, only made possible because of the Fed, right, and the other central banks. And fiscal policy hasn't hurt neither, right? We are recovering. And when we recover, the bottom line is stocks do well. You can see how these green bars, right, stocks have done very well in the early cycle environment. They don't do well in a recession, but good news is we're no longer there. The other component is fixed income, which should continue to be a significant component in your portfolios, has fairly benign returns, right, throughout the entire cycle, and it does really well in a recession. That's why we have bonds, right? So starting, or I should say finishing where I started off, the virus continues to remain an uncertainty. We don't have the cure yet. It is only a matter of time, but that time could be 6, 12 months, right? Kind of pick your time frame. This should certainly provide a positive tailwind. But until we get this ultimate tailwind in the books, we know that we should remain highly diversified. We should continue to stay invested in the market because frankly, there's going to be a lot of durable positive catalysts that are going to present themselves, or continue, I should say, to present themselves. And we don't want to miss that growth, right? Even though we have this, quote unquote, ugly election in front of us, we really believe that election is going to be nothing more than a benign catalyst, not to, again, spoil the party. On the flip side, we know there will be downside volatility. People are still spooked out by a lot of different things, namely of which the virus continues to be that headwind. That's where we need to continue to diversify into bonds, right? Beautifully boring bonds. Maybe you won't make a lot of money in them, but that's the point, right? They are a yin versus the yang, and they're certainly a very nice a piece of ballast, if you will, against some of the chop that we're going to see in the markets here over the next 3 to 6 months. So choose the path, stick to it. Obviously, continue to work with Alex and Cliff and the rest of the folks at Cornerstone, and we feel like you'll be in good hands. I'll pause here. I spoke a little bit longer than I thought, but hopefully that was informative and people have questions.
Yeah, thanks, Brad. That was a great presentation. I hope that everybody on this call watching is, obviously got maybe a few of their questions answered. I know my client specifically, the election is definitely the talk of the moment in terms of as we approach the rest of this month and early into November. I can also appreciate your reference to the 28-3 halftime deficit that the Patriots overcame. As a native Charlottean, seeing the Falcons not do well makes a Carolina Panthers fan heart, do well. So,
all right, good. We're on the same page.
We won't associate any political preferences to either team, but I can appreciate the Panthers side of things. But yes, if anybody has any questions, please feel free to go ahead and submit them now while we have a few more minutes with Brad and John with us. If we don't have any more questions, and I'll wait a moment or so, but we appreciate everybody that's been on this call. If you're a client or if you are a guest of a client that has joined us today, like Brad said, staying invested, having your appropriate plan in place is really the key here. Making large decisions or impactful decisions, at a time like this when volatility can potentially be higher. Really, that's why we have a plan in place, and that's why we make sure that you're not always invested into the equity markets. The majority of our clients, you're going to have a balance between those equity positions as well as your fixed income. So we do appreciate always hearing that. And so actually, Brad, we do have a question. So let me read this off for you. So if we have a bad fall into winter where COVID spikes, what is the expected impact? And I think actually you talked about this. I know you have some other slides. I don't know if you have them with you, but specific to COVID, what is Fidelity's take from a impact of COVID if it were to spike here in the fall and become kind of that second wave that they talked about?
Yes. So we've heard the second wave argument all year through since March. A lot of us thought maybe in July with the Sun Belt states, the Carolinas to a lesser degree, but certainly Arizona, Texas, and Florida, we saw a precipitous tick up in cases. It didn't help the narrative any, but what's very important to observe is whether it was in July, whether it's now in parts of Europe, other parts of the Midwest, right? We're seeing certain zip codes or communities where we're seeing a precipitous spike in the number of cases. The encouraging sign here is that we are not seeing any blunt, homogeneous shutdowns, right? We are seeing very pinpointed, maybe pullback a little bit, right, in terms of, the fun that we used to have as a society. You think of United Kingdom and London, not sure how they're faring out there, but the bars have been shut down. Something tells me they're doing just fine drinking elsewhere. But so that's a smart shutdown as opposed to just shutting down things carte blanche. Same thing here in New York City. We're seeing 10 different zip codes in the Bronx and in Brooklyn that have shut down, but not the entire city, right? Not all 8.5 million people are subject to this widespread shutdown. So I've heard it, we've seen it, but even when we see influenza pick up, what we need to make sure we're doing is, because there is a crossover of symptoms between COVID and influenza, we need to discern between what is truly influenza and what is COVID. And the most prevalent way we can discern or make that distinction is via testing. The good news is the United States is now at 1 million tests per day in the country. That came up from 100,000 back in April, 200,000 into the summer. You know, we were hitting 500,000 in August into September. Now we're at 1 million, and we suspect we'll be at 2 million tests per day towards the tail end of the year. That's going to be obviously important for transparency. And what that will also do, and this is just my opinion, okay, is what that will most likely do is that will increase the number of positive cases, right? Personally, we feel like the number of new cases we're seeing is a direct byproduct of the precipitous increase in testing. And here's why we say that. The positivity rate is less than 5%. It was closer to 10% in the summer. So the percentage of tests that are coming back positive is lower today than it was 3 months ago. That isn't just an observation. That is a highly relevant observation. And even the CDC or the World Health Organization would tell you that is a positive. Now, 5% is still too high. We'd like to get down to 3 or even 2%. And the one way you get there is by testing more people. The other component is the people who are testing positive, for the most part, asymptomatic with highly mild symptoms. So eventually what will happen, and again, this is our opinion, is we will see the mortality rate drop precipitously, right? So if we continually test people and we continually have more and more positive cases, but yet we don't see, the same percentage of fatalities, that obviously could bode well in terms of the overall narrative around COVID. What if COVID is no more deadly than the annual influenza? I mean, again, that's a good question to ponder, and we don't even feel like there's a consensus as to if that's a true or falsehood. And again, I'm not saying it is, but I'm just suggesting eventually we may get there. So we don't expect any major widespread lockdowns. We are learning to live with COVID. We're wearing masks when needed. We're continually socially distancing. And as long as we do that, we feel like we can, let's just say, prevent what we saw back in March and April, because looking back on it, that was probably way too blunt of a tool to mitigate this situation.
Yeah, no, thank you. And that was a great response I can appreciate, because as you say, the bluntness with which we went through, and now that we're 7 months in, or approaching our 7 months, we're learning more about COVID each and every day. And while we always, hope that we'll get to that point sooner than later, where we have a vaccination, where we have successful treatment plans that hopefully continue to result in more people recovering than obviously loss of life. Anybody would hope for that. So
that's right.
If there's no more questions, again, I want to thank Brad and I want to thank John for setting this up. This has been a great presentation, great webinar. I know, again, as I went through this with you once already, I've learned even more, again, having gone through it a second time now. For those of you who are on the call with us, if you have any questions, please reach out to your advisor. If it's myself or anybody else within the firm, please reach out to your advisor if you have any questions specifically to how the COVID season or how COVID will impact your portfolio or could impact it, how the election season as we approach that and changes that may take place and how it could impact your portfolio as well. Again, thank you for your time. If there's anybody that we can help you with, if there's any friends or family, please pass along your information. Feel free to share this webinar, and we look forward to seeing you again soon. And thanks again, Brad.
Thanks, Alex. All the best to everybody, and thanks again for the attention.